Welcome to the deep dive. You've brought us some really interesting sources this week, looking hard at the U.S. bond market and, well, the potential trouble with tariffs.
Yeah, definitely.
So our mission today really is to sort of connect these two areas, bonds and tariffs, and figure out why the current situation, especially with the bond market plus these tariff risks, could be, a serious issue for the U.S. economy.
Absolutely. They seem separate, but the materials, they really show how linked they are. Understanding that link is, I think, crucial right now.
Okay, so let's dive right in. The bond market first. U.S. Treasury bonds. They're basically IOUs from the government, yeah.
That's the simplest way to put it, yes. The government needs money. It issues bonds, promising to pay back the loan plus interest. That interest is the yield.
Simple enough, but who's actually buying all these? Who's lending Uncle Sam all this cash?
Well, it's a mix, but a huge chunk, a really significant amount, is held outside the U.S. We're talking foreign countries, banks, big investors.
Yeah.
Your sources mentioned something like $8.5 trillion held overseas as of 2025. That's massive.
Wow. $8.5 trillion.
Yeah. And some big holders specifically mentioned are Japan. They hold over $1 trillion worth.
A trillion, just Japan.
Just Japan. Then you've got Canada, $350 billion. And the EU countries combined holding around $1.5 trillion.
So why do they buy them? Just a safe bet.
Pretty much. U.S. treasuries are seen as, one of the safest places in the world to park huge amounts of money and earn a predictable return, that yield we talked about.
Okay, so the U.S. government uses this borrowed money for, well, everything, right? Military, Social Security, infrastructure.
All of it. It funds government operations.
So we're pretty reliant on these other countries continuing to buy and hold our debt, which sounds a bit risky. What happens if they maybe coordinate and decide to sell off a bunch of these bonds?
That's a potential danger, exactly. It could be quite serious.
How so? What would happen?
Well, think about basic supply and demand. If a few major holders suddenly start selling large amounts of U.S. bonds,
the market gets flooded.
Precisely. A flood of supply. And when supply shoots up like that, the price of the bonds goes down. Has to.
Right. And this is where that inverse thing happens. Bond prices fall, interest rates, they go up.
Exactly that. It's a bit counterintuitive maybe, but imagine a bond was sold for $100 and pays $2 interest a year. That's a 2% yield.
Okay.
Now, if heavy selling pushes the market price of that same bond down to, say, $90, it still pays that original $2 interest. So someone buying it for $90 is now getting $2 on a $90 investment. That's a yield of more like 2.2%. The yield has gone up because the price went down.
So to sell new bonds, the government would have to offer that higher interest rate or yield to compete.
You got it. Interest rates, yields, they spike.
And these aren't just numbers on a screen. Spiking interest rates, that has real consequences for the U.S., right? The sources suggested a pretty grim dominant effect.
Very real consequences. First, the government itself. It suddenly costs way more to borrow money.
And the U.S. already has, $34 trillion in debt?
North of that, yeah. So imagine your mortgage interest rate suddenly jumping significantly. That's the kind of pressure it puts on the national budget. It makes managing that debt incredibly difficult.
Okay, that's bad enough. What else? Does it hit the dollar?
It likely would, yes. If countries are selling U.S. bonds, they're selling dollar assets. They might convert those dollars to other currencies. More dollars floating around internationally can weaken the dollar's value.
And a weaker dollar means imports cost more.
Exactly. Everything we buy from other countries gets more expensive. That feeds inflation right here at home.
So higher borrowing costs for the government, a weaker dollar pushing up inflation. One source mentioned the risk of, a depression. That sounds extreme. How could it get that bad?
It's a chain reaction scenario outlined in the materials.
Yeah.
First, if government borrowing costs explode, they might be forced into huge spending cuts.
Like cutting essential services.
Potentially. Social programs, infrastructure, R&D. Massive cuts could mean job losses, slowing the whole economy down. Then businesses feel it too.
Higher interest rates for them as well.
Yep. Loans for expansion, for investment, for payroll even, they all get more expensive. So businesses might pull back, stop hiring, maybe even lay people off.
And we already mentioned inflation from the weaker dollar hitting consumers.
Right. Squeezing household budgets.
Yeah.
And then there's the confidence factor. If there's a panic about U.S. debt, that could easily spill over into the stock market, the banking system.
Wow.
It's a potential perfect storm.
Wow. There was an analogy in one piece about a real estate mogul selling just a small percentage of their houses, but it causing chaos. How does that apply here? It's not like they'd sell all $8.5 trillion at once.
No, certainly not. But the point is, even selling a fraction of those huge holdings can dramatically increase the supply available on the market at any given moment. It disrupts the balance.
It creates a liquidity crunch? Is that the term?
That's it. Suddenly, there might not be enough buyers ready to absorb all the bonds being sold without prices dropping sharply. It makes it hard to trade smoothly, increases volatility, and just generally gums up the works of a market that needs to function efficiently.
Got it. So it's not just the total amount, it's the rate of selling that matters. And it doesn't even have to be a sudden shock, does it? The boiling frog idea.
Right. One source brought that up. Even a slow, steady selling pressure, maybe from a country like China, gradually reducing its holdings over time, can keep pushing yields gently upwards.
Nudging interest rates higher and higher.
Exactly. It might not cause immediate panic, but it slowly erodes the economy's strength, makes everything gradually more expensive, like the frog not noticing the water getting hotter until it's too late.
And that brings us to the 10-year Treasury yield. It always gets mentioned. Why is that specific one so important?
It's sort of the benchmark. It's the rate that a lot of other borrowing costs in the economy are pegged to, or at least heavily influenced by. Well, mortgage rates are a big one. Car loans, corporate bonds, the rates businesses pay to borrow. So when that 10-year yield goes up,
everything else gets more expensive too. Mortgages, car payments.
You got it. It hits home buyers, businesses trying to invest, and it makes the government's own borrowing even more costly, adding to that debt problem we talked about.
And potentially pulls money out of stocks.
Yeah, that's another risk mentioned. If investors can suddenly get a much better, safer return from Treasury bonds, they might sell riskier assets like stocks to buy bonds instead. That could drag the stock market down. It really ripples everywhere.
So just to really hammer this home for everyone listening, this bond market stuff, these yields, it's not abstract. It directly affects your mortgage, your car loan, the health of the company you work for, the value of your retirement savings. It's all tied together.
Absolutely. It underpins so much of the economy, and this is where the tariffs come in, because they can really pour gasoline on this potential fire.
Okay, let's make that connection. Tariffs. The Dean Blundell piece you shared mentions some pretty scary scenarios being floated, like 125% tariffs on China, 25% on Canadian auto imports, a global trade war.
Yeah, it painted a picture of very aggressive trade actions being considered, actions that would likely provoke strong reactions.
And the article talked about Canada's response, specifically from Mark Carney, who was Prime Minister then. It wasn't just about hitting back with tariffs, was it?
No, and this is fascinating. According to that source, Carney pursued what it called a quiet bond play. Canada actually started increasing its holdings of U.S. Treasury bonds.
Increasing? That seems odd if they're expecting a trade war. Why do that?
The thinking, as presented in the article, was leverage. Building up a bigger stake gave them more potential influence over the U.S. bond market.
Ah, so it wasn't just about finding a safe place for money, it was strategic.
That's the interpretation, yes. The article suggests Carney then coordinated, or at least communicated, with allies. Think the EU, Japan, other major holders of U.S. debt.
What was the message?
The implied message, according to the source, was, if these huge tariffs go ahead, especially against us and our allies, we might start a coordinated, slow, steady sell-off of our U.S. Treasury holdings.
Wow. So weaponizing their bond holdings.
Essentially, yes. Threatening to trigger that boiling frog scenario, or maybe something faster, if the U.S. pushed too hard on tariffs. It's described as a kind of financial checkmate threat.
And did it work? Did this quiet bond play have an effect?
Well, the article argues it did. It suggests this strategy was a key factor in causing a pause on the really aggressive tariff threats against Canada, the EU, and Japan.
But not China. The tariffs on China still went up significantly.
Correct. The 125% tariff on China mentioned did proceed, according to the piece, but the threat seemed potent enough to deter similar actions against the other major economic partners involved in this potential bond coordination.
So the threat of messing with the U.S. bond market was actually a stronger deterrent than just threatening retaliatory tariffs.
That's the argument put forward. Retaliatory tariffs hurt both sides, obviously. But a coordinated attack on the U.S. bond market, hitting U.S. borrowing costs, and the dollar's stability, that strikes at a core vulnerability.
Because the U.S. dollar is the world's reserve currency.
Exactly. It's our superpower, but it also creates this vulnerability, this yield exposure, as one source called it. So many countries hold our debt that actions affecting U.S. yields have global repercussions, but they also give those holders leverage against the U.S. if they act together.
The article also mentioned Canada issuing its own bonds, but in U.S. dollars. What was that about?
That seems like another smart defensive move. By issuing their own debt in USD, Canada could tap into global U.S. dollar funding pools, maybe build up reserves, and just generally strengthen their financial position independent of direct reliance on U.S. markets. Gives them more options.
So tying it all together, imposing big tariffs isn't just about trade fights over cars or steel. The bigger, maybe hidden risk is that it provokes countries to retaliate not just with their own tariffs, but by using their U.S. bond holdings as a weapon.
That's the core connection, yes.
Which could then trigger all those negative things we talked about, spiking interest rates, weaker dollar, recession risks.
Precisely. It dramatically raises the stakes of trade disputes. It shows how interconnected financial markets and trade policy really are. Actions in one sphere can have really dangerous unintended consequences in the other.
You know, one source plainly warned that policies like aggressive, broad tariffs are economically dangerous and fundamentally undermine American power. This bond market vulnerability seems to be exactly why.
It really highlights that vulnerability. When you rely on the rest of the world to finance your spending, you give them a certain amount of power. And if the U.S. is seen as unreliable or intentionally disruptive to the global system,
they might just use that power.
It becomes a distinct possibility. It underscores the need for careful consideration of how U.S. actions might be perceived and reacted to in these critical financial markets.
Okay, so for everyone listening, let's sum this up. The key takeaway seems to be the U.S. bond market is incredibly important, maybe the bedrock of the financial system. But because so much U.S. debt is held overseas, there's a vulnerability there.
A significant one, yes,
right.
Especially to coordinated action.
And aggressive tariff policies, they don't just risk trade wars. They risk provoking exactly that kind of coordinated action in the bond market, which could seriously hurt the U.S. economy through higher interest rates and instability, way beyond just the cost of goods.
That's the crucial link. The potential for tariffs to trigger a bond market backlash is a major risk factor that needs to be understood. It shows how trade and finance are deeply intertwined on a global scale.
It really makes you think differently about trade headlines. It's not just about exports and imports. These subtle or maybe not so subtle shifts in bond holdings can have huge real-world impacts.
Absolutely. Financial leverage can be incredibly powerful in international relations.
So it leaves us with a pretty big question, doesn't it, thinking long-term? Given this reliance, this vulnerability related to foreign debt holdings, what can the U.S. even do to make itself more economically secure? How can it build resilience against these kinds of potential shocks, whether from economic shifts or, future policy choices that might provoke a reaction?
That is the multi-trillion-dollar question, isn't it? There are no easy answers. But it definitely involves thinking about debt, about global relationships, and about the consequences of domestic policy on the international stage.
Definitely something to chew on. That's all the time we have for this deep dive. Thanks for walking us through that complex connection.
My pleasure. It's crucial stuff to understand.